Hi guys, welcome to this Money Control live stream. I am Nandita Khemka and you're watching Opening Bell right here with me from the studios. This morning the global setup is looking fairly positive, but remember yesterday we saw very crazy moves in the market, around midday. When we were, oscillating between green and red, but the moves were, quite significant. A 200-point move, both on the upside and downside. That's the kind of volatility we saw yesterday, and the India VIX index also at 6-month high. So extreme volatility, and we were also digesting cues from US. The new US president Donald Trump and the kind of policy announcements that he has been making. We've been taking note of that in terms of tariff as well. Earlier yesterday there weren't any cues as to how he would put tariffs on China, but yesterday in the night there were comments that he is looking to impose a 10% tariff on China, and that could happen as early as February. But that's softer than expected, because talks of 60% tariff were also doing the rounds, and that had got the market really worried. But in terms of India, of course, what he does on the tariff front will be a wild card going forward. No word yet, but he has of course warned the BRICS nations that if they are looking at de-dollarization, then be prepared to pay tariffs to the tune of even 100%, and that would not be good news for us. But yes, this morning the GIFT Nifty hinting at a positive start. Lots of earnings to watch out for. Big ticket earnings, HDFC Bank, HUL. Those are some of the earnings that would decide which way we will move from here. Because yesterday, 23,047 on the downside. That's a recent swing low that was taken out on a closing basis, and that should be a cause of worry. But if we break below 23,000 mark on a closing basis, who knows, we could see a fresh leg of sell-off in the market. But lots lined up over the next 35 to 40 minutes. We'll be taking stock of all the stocks and news, all your stock related queries, which you guys should keep sending us on our live feed. And of course, we'll take stock of the earnings as well, and we'll get you a fundamental voice as to how should one be navigating this volatile market ahead of budget, and even post budget, what are the themes that would be watched out for. But yes, before we move any further, let's quickly take a look at the top headlines at this hour. Positive close on Wall Street, with the Dow Jones surging over 500 points as investors digest Trump's softer than expected tariff stance. The US 10-year yield eases to the lowest closing level since December. Asian markets mirror Wall Street sentiment to start the day in the green. As I mentioned in the opening comment, China, the tariff there could be at 10% as hinted by Trump, and it could be imposed as early as February. But of course, we will wait and watch for that. GIFT Nifty hinting at a positive start. Of course, taking stock of yesterday's crazy moves, we will be watching out for how volatile the market will be here back home. Oil prices slip on oversupply concerns after US President Donald Trump declared a national energy emergency as part of plan to drastically boost domestic production. Meanwhile, gold prices rise on safe haven demand amid easing of the US dollar. And in key earnings today, Hindustan Unilever is likely to report a flattish profit growth, and volume is expected in the 1 to 2% range. For HDFC Bank, net interest margin and asset quality are expected to remain stable. Also watch out for numbers from BPCL. All right, then, taking cues of, market cues really, let's take a look at that. The markets did end at a 6-month low. Amid extreme volatility, the Nifty breached that 23,000 level for the first time since June 2024. In earnings reaction, we saw very sharp reactions coming in from Zomato, MCX, Oberoi Realty, Dixon Tech. All of these stocks fell anywhere between 10 to 15% yesterday. Frontline indices fell around 1.5% or thereabouts. Remember, FIIs have been relentless sellers in the market, months to date. In fact, since the start of 2025, they would have, pulled out as much as 55,000 crore rupees from the Indian market. Yesterday, also they were sellers to the tune of over 5,000, in fact, nearly 6,000 crore rupees or thereabouts. There was pain in the broader end of the markets as well. The market breadth was skewed in favor of laggards. BSE listed companies erased market cap to the tune of 7 lakh crore rupees in yesterday's sell-off. Realty, that was one pocket that was on extreme shaky ground, given the fact that that index lost somewhere around 4%. If you look at some of the gainers, which were few and far between on the index level, Apollo Hospitals, held out in a weak market. OMCs were gaining, of course. Trump's drill baby drill. That's what he said on the energy front. They will be jacking up production on fossil fuels, and that would bring down crude prices, which will be a positive for OMCs. And remember, BPCL reports numbers today. So ahead of that, the entire OMC pack was buoyant in trade yesterday. Of course, Zomato, some competition concerns on quick commerce segment, margins concerns there, and that was flagged off by brokerages, and the stock saw a beating for a second day on the trot after reporting numbers. Even stocks like Paytm, Delivery, all the new age companies, Swiggy for that matter, all of them fell in trade. And Trent, that's another one, that stock continues its downward streak. Mind you, this was the best performing stock of 2024, and since 2025 started, it hasn't been such a great year for Trent. It is in fact below key moving averages as well. Let's take stock of some of the other pointers then. The put call ratio from the, if you take a look at the FNOQs, dropped sharply to 0.77 vis-a-vis 1.03 in the previous session. And if you look at some of the stocks that are in the FNO band, the new entrants are the likes of Dixon Technologies, which again saw a 15% cut yesterday. Mahanagar Gas, that's the other one that has entered the FNO band list. Still in FNO band, we have stocks like Aditya Birla Fashion, Angel One, Bandhan Bank, Canfin Homes, Kalyan Jewellers, L&T Finance, Manappuram Finance and RBL Bank. As I was mentioning at the start of the show, FIIs net sellers to the tune of 5,900 crore rupees, but DII buying support continues. Domestic investors bought shares to the tune of 3,500 crore rupees in the cash market. But let's understand the setup for the market for today after yesterday's volatility. Let me bring on board Rajesh Palviya of Axis Securities. Rajesh, great to have you on the show. What do you make of yesterday's wild swings? 23,000 held on to that, although we did break below that on a intraday basis yesterday. But the recent swing low has been broken. Would you be concerned about approaching death cross once again on the charts?
Good morning, Nandita. Yeah, so it was very intense selling pressure in the previous day, and almost we have broken 23,000 put-based concentration in the intraday basis. But some recovery at in last half an hour has managed to close about 23,000 level. But still, looking at the overall setup, broader market, the trend is still on the weaker side. Though Nifty and Bank Nifty both attempted to recover in last couple of days, but again, failed to sustain at higher level. And both Nifty and Bank Nifty again, witness the supply pressure from their, major call concentration area, or we may say like, from their, technical resistance level. Nifty is still having a major supply zone at 23,350, 400 zone. Until Nifty not crosses those level, whatever minor pullback which we are witnessing in the market will meet to the supply pressure on the higher side. On the downside now, 23,000 is the very important and critical level to watch for in the today's session as well as in the coming days. If we breaks below 23,000 level, then downside is open for 22,800. That's the immediate level where we can see Nifty to, slide further. So as of now, setup is still on the weaker side. Sell on rise would be the strategy for Nifty as well as for Bank Nifty also. Bank Nifty also, not able to cross 49,200, 300 zone on a closing basis. And again, supply pressure is still there around those level. So for Bank Nifty also, we are holding our bearish view at this juncture. And we believe that, the way Bank Nifty has broken the important support area in the previous day, possibly we may see further more downside in the Bank Nifty also, and 48,000, 47,800 would be the next critical support area for Bank Nifty if it remains below to 49,200. So that downside is still open for Bank Nifty also. So both indices are looking weak at this juncture. Very few stocks are holding the ground at higher levels. So there is no leadership at this moment to support the indices at this juncture. So I think sell on rise would be the strategy one should follow till Nifty not crosses about 23,400 on a weekly closing basis.
Okay, 23,400 on a weekly closing basis will be watched out for, and let's not forget about the kind of volatility that we have seen in the market. But ahead of HDFC numbers, HDFC Bank, how would you really trade into the counter? We saw that there were signs of recovery on the Nifty Bank index right after Kotak Bank's numbers, but that has completely fizzled out. And as you said, the setup on the Nifty Bank index is fairly bearish. But no leadership from anywhere. HDFC Bank as well, hasn't really been able to hold up. And even in terms of numbers, loan growth is likely to remain weak. And of course, it has its own set of issues. It is looking at, reining in its loan to deposit ratio. What are your thoughts on HDFC Bank? How are you positioned ahead of numbers?
So the trend is still on the weaker side, and stock is hovering near to its 200-day moving average since last 4 or 5 trading session, and still not able to give breakout about 200-day moving average. So immediate resistance for trader or for near-term traders are 1680, 1690 zone. Until the stock not crosses this zone, a trend is likely to remain on the weaker side. Stock is almost approaching to its July swing low, which is placed at around 1630. If it breaks below 1630, furthermore follow-up selling towards 1600, 1580 we may witness in the HDFC Bank.
Okay, that's the view on HDFC Bank, and of course, we have started the day on a positive note, at least this Wednesday morning. But the mid-cap index has, slipped into the red as we speak. On the index level, it's a 0.3% kind of gain, 70-point kind of a up move on the index. We're just about hovering around that 23,100 mark. Sensex up 200 points. The Bank Nifty as of now, very mild gains, just about 20 odd points. So 48,600 is where it's at. And as Rajesh was mentioning, HDFC Bank will be a crucial one to watch out for. That could decide which way the Bank Nifty will really head. But let's take a look at some of the other sectors and what they are up to at the current juncture. Because the gains are fairly mild. Whether or not we can sustain, any early gains is something that we'll watch out for as we progress throughout the day. But India VIX has cooled off slightly, just about in the negative territory. We are seeing green ticks on most of the sectors, but metals are in the red. Of course, there is news flow that Trump may, levy a 10% tariff on China. Of course, whatever happens in China, metal pack gets impacted because a lot has to do with demand coming in from China. So metals down 0.5%. Aside of that, oil and gas index, that's down 0.3%. PSU Bank index also trading in the red. But what's doing well is the FMCG pack ahead of HUL numbers. Hindustan Unilever that reports numbers today, 0.4% kind of an uptick on the FMCG pack. As of now, autos and banks are holding out. In IT stocks are doing well, 0.6% kind of gain coming in there. Just want to point out that Trump has announced a major infrastructure plan and investments in AI. So that AI infrastructure, so that could follow through. Some benefits could accrue to Indian IT as well. Perhaps that's why we are seeing strength coming in on the IT pack, 0.5% higher. If you take a look at some of the other stocks, individual stocks that are moving, FMCG names are dominating the list this morning. Britannia, HUL, ITC, all among gainers. From the pharma pack, you have Sun Pharma doing well, Infosys up 1%. You have Shriram Finance that was in a spot of bother for the last few sessions, has managed to edge back into the green, 1% gain coming in there. Even Tata Consumer is doing well. Wipro is doing well. HDFC Bank ahead of numbers showing some strength. And you have Maruti Suzuki also doing well. Nestle, Reliance Industries as well. 0.5% gains coming in there, providing support to the index. On the flip side, Trent, this stock, as I was pointing out, is among the worst performers. If you look at the movement for the month, Last year it was among the best performers on the index, but today as well it's down 1.5%. We saw 1 or 2 sessions of gains, but the stock has not really been able to stage any kind of a comeback. Tata Motors in the red, Hindalco, Tata Steel, Coal India, all these metal names under pressure. But looking at the open, Rajesh, I want to first get in your thoughts on trend. It is below all its moving averages, below key support levels as well. The kind of sell-off that one has seen on shares of Trent, how do you really navigate?
Almost 20% cut during the this month itself for Trent, and looking at the near-term, short-term structure, stock is now in the weak zone. Stock is now slipped below to all its near-term, short-term moving averages. The way weakness is visible on a weekly chart as well as on the daily chart, we believe that if it's sustained below to 5,850 zone, I think we may see further more cut in the stock in the coming days. Possibly stock may slip towards 5300, 5350 kind of zone in the continuation of this down move. So that level can be we can see in the trend going forward. So sell on rise would be strategy. For trader, 5850 should be stop loss. For positional trader, 6000 would be the level till the stock not manages to recover above 6000 level. Whatever minor pullback you are getting it, you can go short or you can exit from your position if you are stuck.
That's about trend, but what about Hindustan Unilever? Numbers are going to come out today. Of course, there's this whole urban slowdown that's been weighing in on earnings growth for most of these FMCG names, particularly for HUL. Profits are likely to remain flat amid heat wave, price cuts and stable commodity prices. Revenue is likely to grow somewhere around 4.5% to 5%. Subdued performance is likely across categories. Volume growth, which has anyway been subdued, is likely to come in at 1%, a meager 10%, a meager 1%. I beg your pardon. Home care is likely to lead with a 2.5% growth. Beauty and personal care revenues are likely to rise by around 2%. There could be some weakness in the food drink portfolio, and that may drag overall food and refreshment segment as well. And higher raw material costs are likely to weigh on margins. The key to watch will be, of course, how demand is panning out in metro areas and tier 3 towns as well. FMCG names, A ahead of HUL numbers and B ahead of budget. Are you looking at it? Because last week we did see some bit of buying coming in after a long period of underperformance.
So there is two view for FMCG pack at this juncture. Ahead of number, yes, most likely most of the stocks are going to deliver subdued, quarterly performance. So maybe a price pressure would be there according to their, quarterly outcome. But again, there is a high expectation towards the budget to, get some boost towards the consumption. So if anything comes to boost the consumption, that could be positive for FMCG pack as a whole. But again, looking at the structure, still most of the stocks are trying to get some support buying action at lower level, but still a trend is weak for most of the stocks. So there is no as such clarity at this juncture whether the stock will able to give some pullback or we may see further more continuation of down move going forward in the coming days. So I think case to case we need to take a call. As we discussed, trend structure is weak. HUL is still trading near to its important support area of 2320. If it slips below to 2320, then we may see further more cut towards the level of 2260, even 2240 kind of level on the downside. As still structure is weak, and on the weekly chart, HUL is traveling in falling channel. So I think. Until the stock not crosses about 2400 level, trend is likely to behave on the weaker side. Even if we analyze on the other stocks like Dabur, Marico, all these stocks are trying to consolidate since last couple of week at lower band of their correction. But again, their quarterly earning would be important to take out these stocks from this consolidation on the higher side, or any boost from budget to the consumption may give some recovery in this stock. So if you want to play ahead of number, I think stock specific call you need to take. But ahead of budget, if you get any correction in next couple of days, would be again, opportunity to buy these stocks with a very tight stop loss, because risk to reward would be in favor. And I think there is a high expectation from this budget to have some kind of, announcement to boost the consumption that may convert into the profitability or to boost their profitability going forward.
Okay, that's the view on consumption. But let's shift focus to some other stocks that have been making headlines, and of course also try and integrate them with the queries that we are getting this morning from our viewers. I was going to talk about Reliance Industries with you. So we have a query coming in from Anand Swaminath on Reliance Industries. He wants your views on the stock for the next 2 months after numbers, and even otherwise the view on the street has been fairly positive when it comes to the stock, with target prices in excess of 1600 rupees as well. The stock has done well on a month to date basis, when the markets haven't been doing all that well. On the month to date basis, we've seen an almost 5% gain coming in on Reliance Industries. How would you look at the stock with a 2 month perspective? Risk reward looking good now after a long period of underperformance?
So almost a correction of 5 month we have already seen in the stock. Stock corrected from the 1600 level to all the way to 1200 level. Some recovery is taking place. So at this juncture, for near term to short term, 1200 is likely to act as a major, support zone for the stock. Looking at the near term structure, stock managed to hold about 20-day as well as 50-day moving average in the previous rally. So I think if it's sustain about 1240, 1250 zone, there is a possibility that, stock may attempt to move higher towards 1300, 1320 zone. If at all stock crosses about 1320, then we may witness some more short covering action to take stock further higher towards 1360 to 1380 kind of zone also. But looking at the market behavior, the volatility which we are witnessing in the broader market, I think some consolidation in range of 1230 to 1290 we may see in the coming days for Reliance. Either side breakout or breakdown will decide the major direction for the stock. But those who are already in the trade can hold the position with stop loss of 1230.
All right, that's the view on Reliance Industries. Hope that answers your query. But the next stock on my list, is an obvious one. Zomato has shaved off almost 20% in a matter of few sessions, right? And numbers came out. A lot of concerns about margins when it comes to quick commerce, intensifying competition. A lot of growth capital being pumped into the quick commerce space, and that could, of course, impact the margins in the near term. And a lot of brokerages have flagged that off as well. Last two sessions, I think we've seen quite a big sell-off. The stock is barely holding on to that 200 level. We have a query from Naveen coming in. He wants to know whether one should hold or exit. He's making a loss of 15% here. What would your advice be, Rajesh?
So there was a disappointment in the earnings for Zomato, and we have seen the reaction to the stock in line with the earnings. And I think the way stock has broken its important support area of 240 on a weekly chart. So I think till the stock not able to cross about 240, trend is likely to remain on the weaker side. Possible down move can extend to 190 zone also. That level needs to review in the coming days. If it's not able to sustain above 190, I think further more downside would be open. But at this juncture, we are projecting target of 190, where some support buying action can be visible. So wait for 190 level to, again review it or to buy some quantity around those level with stop loss of 185. On the higher side, 240 is the critical supply zone. Until the stock not crosses those levels, I think stock may remain in range of 185 to 185 to 240 for next couple of week. Either side breakout will decide the major direction for the stock from here onward.
Okay, that's the view on Zomato. Hope you've taken note of it. Let's move on to the next query then. This is coming in from Debu K on Oberoi Realty. The stock was down 7% yesterday, and today there's no reprieve. We have seen I think the stock is down another 6%. So almost a 15% cut coming in. If you look at the last 5-day performance, a matter of 2 sessions, 13% almost shaved off. Numbers weren't all that bad, if I recall correctly. How are some of these realty names poised on the charts, given the fact that we saw a good 4% cut on the realty pack yesterday, and this index had already entered the correction territory. If you see, on a month-to-date basis, I think it is among the worst performers, the realty pack. How would you really navigate some of these stocks, and what's happening with Oberoi Realty in particular?
Well, I think as a high frequency indicators are indicating some slowdown in economy. So I think that impact is coming to the real estate space also. And I think most of the stocks have witnessed profit taking as well as supply pressure since last couple of week. Oberoi Realty, after having a decent run up towards the level of 2300, it's witnessing now, supply pressure for fourth consecutive week. Stock is making lower high low formation. That clearly shows that if there is a sustained supply pressure, and now stock slip below to all its near term short term moving averages. So looking at the near term short term structure, I think trend is likely to remain on the weaker side. Maybe stock can correct further to the level of 1600 in the continuation of this down move. Until the stock not crosses above 1820, 1830 zone, trend is likely to remain on the weaker side. So one can go short in the stock also in minor pullback action with stop loss of 1820 for downside target of 1600. Even if we analyze other real estate stock like Prestige State, again, here also we have witnessed a breakdown on the short-term chart. Stock is continuously moving in down sloping channel on a daily as well as on the weekly chart. So we believe that in the way most of the real estate space have witnessed the supply pressure in last couple of weeks. I think uh, there could be further more cut if it's market if broader market doesn't recover in the coming days. So I think we may see pain in the real estate space. Also, real Prestige State can slide further to the level of 1260 to 1240. So here also we have a bearish view at this juncture. One can go short in minor pullback with stop loss of 1390 for Prestige
Right.
also.
Right. Let's quickly get the last query for the day. Then, it's on an Indian hotels coming in from Nanda Reddy. Wants to know why is it falling despite good results. Any thoughts on the charts of Indian hotels?
So stock has run up quite well in last couple of month, and almost stock was trading near to its all-time high trajectory for since last 4 5 months. It's a first round of profit taking which we are seeing in this stock. So after having a smart run up in last couple of months, some profit taking is happening in the stock. Though in this profit taking stock is now slipped below to 50-day moving average, and looking at the market conditions, I think this stock is also attracting some profit taking. Maybe stock may correct further from the current level towards the level of 720, 700. But again, overall long-term structure is bullish. So if you want to buy the stock, you can wait for 720 to 700 kind of level. If you get opportunity around those level, you can buy some quantity around those level with stop loss of 680.
Okay, that's about Indian hotels. Hope you've taken note of Rajesh's answer. Rajesh, this wraps up our query segment. But before I let you go, any recommendations for our viewers?
I think on the short side, Voltas can be looked at weak structure, stock broken daily, weekly support area. So I think we may see further more cut in Voltas to the level of 1440, 1430. So one can go short in Voltas future with stop loss of 1530. Another stock that one can look at to go short is Oil India. Here also there is a weakness. So I think one can look to go short in this stock with stop loss of 475. On the downside, stock may correct to the level of 440. So these two stocks again on the short side we are focusing.
All right, All India and Voltas on the short side. With that, Rajesh would like to thank you for taking out time and joining in this morning. Always a pleasure chatting, and hope to see you again next week. Well, then moving on, let's quickly just take a look at the market. We are holding on as of now, 23,000 holds on the charts, just about 50-point uptick on the index. But the broader end of the markets, that's where the pain lies, because the mid cap index is down 1.5% as we speak. And look at the advanced decline ratio on the NSE, it's almost 1:4, replicating what happened yesterday. So, yes, pain in the broader market is visible. Let's see whether or not the headline indices manage to hold on to these slim gains or not. But on that note, let me bring on board our next guest for today. Joining me is Aditya Khemka, who is a fund manager at InCred Asset Management. Aditya, lovely to have you on the show, interacting with you after a long time. Wishing you a happy new year. Not really turning out to be such a great year for the market. But in the wake of the recent volatility, would you expect a larger drawdown going forward, or do you think the worst is priced in and we are somewhere near the bottom right now?
No, so I think the worst may not be really priced in. If you look at the broader market earning growth, be it Nifty 50 or BSE 500, the YOY earning growth seems to be in the ballpark of 7 to 10% for the first half of FY25. Whereas if you look at the valuation multiples, still we seem to be 10-15% premium to historical PE multiples that these indices have traded at. Whereas the historical earning growth has been between 14 and 15% for these two indices. So clearly, we are still the corporates are still reporting below historical averages PE earnings growth, whereas the valuations are still above historical averages, which gives me a sense that we may be done with maybe absolute price correction, but there may be some time correction ahead of us till earnings catch up with the multiples.
Right. But would you say that it's still not the right time to buy and perhaps wait on the sidelines, because earnings season has just started, has lacked excitement, and as you said, it is still above long-term averages, right? So, what should the strategy be really right now? Because we also have a budget coming in, and Trump's inauguration has already happened, but nothing really has come out. Nothing concrete has come up on how he would put tariffs on India as of now. Looking at the kind of language he's adopted, how should one really navigate? Is it time to buy or wait it out?
No, I think we are, at least in our funds that we manage, we have started to put money to work. We are deploying, albeit at a slower pace. So we are still holding on to some cash, but we have started deploying in stocks where we feel the margin of safety has significantly improved from what it was, let's say, 3 months back. So what I would suggest to most of your viewers is to start deploying, but maybe do it in a staggered fashion, so that by maybe around by the middle of February or end of February is perhaps where you should be completely deployed. I think that's where the market is probably like to bottom out, because all the narratives of the Trump initiatives and the budget implications will probably be priced in by the time we are in mid to end February of this year.
One interesting point, I had a chat with one of the fund managers, and he pointed out that, capital protection should be the theme this year, because, returns may be muted in the wake of how earnings growth is panning out. Any themes that one should deploy in, particularly to protect capital and then perhaps look at gains? So, for capital protection, which are the pockets one should look at?
So in terms of capital protection or capital growth, I don't differentiate between the two, because in my view, if you are in equities, we are really there to make more than fixed deposit returns, beat any time frame, right? So the way we are deploying capital at this point is twofold. One, we are deploying in companies which are more exposed to non-discretionary consumption. For instance, healthcare companies, their growth rate would probably be better than the broader market in terms of earning growth, because the consumption there is relatively non-discretionary when you compare it to the broader cyclical buckets. So that's one pocket we're deploying. And second pocket is, for a capital protection standpoint, maybe you could deploy money in stocks where dividend yields are slightly higher, north of 4 to 5%. I think that's where you find more valuation comfort, more margin of safety in a market which is behaving sideways, as we have seen for the past 6 months. So capital protection may be dividend yield, but our investment strategy has always been to find growth at reasonable value or growth at discounted value. And you'll be surprised to know that there are still pretty good names, a good number of names which fall in that bucket at this point, where earning growth will be north of 15% even for this year, and the valuation multiples are not too steep. So we'll probably still end up making some money for our investors.
Okay, where do you stand when it comes to specialty chemicals and in the entire China plus one theme? But because Trump, if you look at his commentary on how he wants to put tariff on China, it's been softer than expected, right? We were hearing 60% and the likes, but he's so far said that 10% maybe starting February. In light of that, China plus one, do you think we are poised to look at that theme going forward, or do you think the softer tone could not really translate into that kind of growth for China plus one, particularly specialty chemicals?
So China plus one basically is happening across many sectors, including specialty chemicals and pharmaceutical API, right? So within specialty chemicals, my sense is that many of these stocks, although the earnings have fallen over the past 2 years, the multiples haven't really corrected significantly, which means some sort of a recovery in earnings is already baked into the multiples of the specialty chemical stocks. And hence, when you buy these stocks at current valuations, the risk you take is if the earnings do not revive the way it's being expected, then you might end up losing some part of your capital. So that is where we actually are not very keen to deploy capital at this point, because we still feel multiples are slightly elevated and hence discounting some of the potential future revival in earning growth for these specialty chemical stocks. So that's a bucket we are still avoiding, because in that bucket we still see more downside compared to the upside that the bucket offers. What we are basically focusing more on is the pharmaceutical API space, where we feel that the China plus one is going to be equivalent, in terms of how it is for specialty chemicals, and their valuation comfort is significantly higher when you compare it to specialty chemicals. So between the two buckets, the call is clearly for pharmaceutical API. But if you just were to discuss specialty chemicals alone as a bucket, then within that bucket, maybe there's just a couple of names where they look interesting enough to deploy. But the larger part of the bucket looks like something which one should avoid at this point.
Sure, point taken. Aditya, in terms of your expectations from the budget, would you expect the government to maintain public spending with capex growth, or do you think in light of consumption slowdown and even signs of slowdown in the economy, the government would do dole out steps to boost consumption? Which way do you think the priorities would lie this time around?
So look, we were amongst the first fund houses. I think we were talking last year about a consumption slowdown, and I don't think that was largely being talked about last year. So we actually foresaw this happening. We foresaw consumption slowing down, and if you see the portfolios that we manage, we are mostly overweight healthcare in those portfolios because that's slightly non-discretionary consumption, and that has done well for our funds in the past couple of years for us. Having said that, from the budget, what we expect the government to do is basically to maintain the pace of public capex, because that remains a critical pillar of GDP growth for us at this point, because private capex has clearly slowed down following slowdown in consumption. So, the public capex will definitely be something that we'll watch out for, and we feel that number should go up substantially to maintain some GDP growth. On the second part, on consumption, we feel government might boost allocations to programs like Manrega, etc., where they will create employment through government programs, which will again help rural consumption. But urban consumption, I think, is something which the government may not be able to do much about, because to boost urban consumption, you have to cut personal tax rates, which is something I don't think the government has looked at for the past 5 years, and I don't think there is enough talk in the street about any potential cut in personal tax rates. So I think urban consumption for now will be slow in the foreseeable future, maybe a year or 2 or 3. But rural consumption is something where we feel that there will be some revival, and it will be government programs like Manrega, which will have higher allocations, and government capex, which will result in more cash in the hands of the rural population, which will result in better rural consumption.
Sure. And in terms of your own wish list from the finance minister, anything that you would like to share with us?
Well, my wish list is something that the finance ministry may not agree with, but what I would love to see is maybe some reversal in the tax rates of individuals, some lowering of tax rates there, so that some urban consumption can get a push. Also, maybe you may increase corporate tax rates slightly to compensate for that reduction in personal tax rate, because corporates would be happy to pay a higher tax rate as long as their revenue growth and their profit growth is substantially higher than what they have been able to do for the past year or so. So I don't think corporates mind paying a higher tax rate on a higher profit base. But if your profit base itself is small, the smaller tax rate doesn't really help. So I think if you ask my viewpoint, I think the government needs to sort of look at personal taxes, which are very, very high in our country, and it's suppressing consumption dramatically. And I don't know if that is something that's on their radar, but that's my wish list.
I think that's the wish on the wish list of a lot of us as well. But Aditya, last couple of questions really. What is your take on this entire quick commerce battle that's playing out? We already saw how it panned out for Zomato in its earnings. Margins from the quick commerce business weren't all that enthusing. EBITDA loss was reported, and a lot of capital being diverted to quick commerce, not gradually but at one go, which is what of course is impacting. In light of that, how would you view these companies? Also, some of them saw a good run up as well already. So, in terms of valuations as well, do you think it's a good space to get into? Because, of course, we have seen weakness pan out for some of these companies. Look at Zomato, lost almost 20% in a matter of 2-3 sessions. Would you look at an entry at these levels?
So unfortunately, in our investing framework, companies that burn cash are not assets, they are liabilities. Even though future, you might predict a future where they will be cash flow rich. That's okay. That's something we will tackle in the future when they become cash flow rich. So we do not invest in companies or even look at companies that do not generate cash flow. And unfortunately, companies like these quick commerce companies fall in that bucket. They are burning cash to garner revenue. That's in our mind not a business. In our mind, that's basically playing with the liquidity that you are being offered by various kind of investors. And we are happy to surpass such opportunities. We are happy to forego such opportunities.
Okay, that's the view on quick commerce. With that, Aditya, would like to thank you for taking out time and joining in and sharing your thoughts. So, would like to connect again, maybe post budget, and discuss all the steps that the government really announces in the budget.
Thanks for having me. Look forward.
Thank you. Well, then, on that note, for the market, still in the green, at least on the index level, but looking at the broad end of the markets, there is a fair bit of pain there. 1.5% cut on the mid cap index. The Nifty Bank index has also given up its early gains, in fact, now trading in the red. And if you look at some of the movers, on the losing front, BEL, Bharat Electronics, that's the top laggard, 2.5% cut. Power Grid closed second. We have Tata Motors, Coal India, Adani Enterprises, HDFC Life, Trent and ONGC. In fact, even BPCL ahead of numbers is now in the red. What's holding up? Tech names, Wipro, Infosys, TCS, all of them holding out. Even Tech Mahindra for that matter. Sun Pharma doing well, Dr. Reddy is doing well. So some of the defensive names are doing well. And so are stocks like ICICI Bank and Kotak Mahindra Bank. But of course, HDFC Bank also trading in the positive zone ahead of numbers. So HDFC Bank, HUL, these are the big numbers to watch out for aside of BPCL. But with that completely timed out on this edition of Opening Bell, thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates, and of course come back and join us on Closing Bell at 3:30 p.m. as well. Have a good day.